performance that we've seen out of South African equities in South Africa. Africa's biggest generic drug maker, Aspen Pharmacare, was the best performing share of South Africa's 40 largest companies last year. Now, Aspen climbed 119% over the year, and it was followed by iron ore miner Kumba, which gained some 88%. Third best was Africa's biggest media company, Naspers, which rose some 80%. And just 3 stocks declined during the year. They were Harmony Gold Mining leading that pack after posting a 22% drop, and property investors Liberty International and Growthpoint were the other decliners, sliding 14 and 6.7% respectively. The broader all-share index added 29% during the year, fueled by record purchases of local shares by overseas investors. That's after the lows hit in March 2009. So we're up 29% on the JSE all-share. Should just put your money into the Aussie and you'd be smiling.
It's been massively impressive. If you consider what we were saying at this time at the beginning of last year, it was really doom and gloom. We were looking at an abyss. We were looking at potentially another repeat of the Great Recession or Great Depression. Nobody could forecast where the markets were going. But unbelievable turnaround in the end that came through on a fairly consistent basis. So in the end, this is the 12th best year in the last 50 years, so that's been good. And yeah, it's certainly been the place to be.
Let's have a look now at this article out again. Mark Mobius from Templeton Asset Management making statements. He's saying that there's an increase in IPOs in the emerging market space, and that for the first time we're seeing emerging markets attracting more money than the developed environment, and that we should heed caution because this could lead to a bubble scenario, and we could see a reversal of some 20% on markets.
Yeah, the last bit we can debate, but I would agree with that. I
hope we're going to debate that quite robustly.
Yeah, I think it's going to be the key feature, or one of the key features for this year. There's no doubt emerging markets are handsomely in favor, including South Africa. Foreigners have been investing here, and all the big emerging markets have done very well and have stood up very well during the credit crisis. And as the crisis unfolded, people recognized, hold on, the emerging markets are really the place to be. And so you had an unprecedented amount of money go from the developed world into emerging markets. And I think there's more recognition that emerging markets have been managed really well. It's not as if this is a fickle thing. It's not as if it's a flight to fancy. It is there's a soundness to the economic management of emerging markets. As that happens, people are now following the portfolio investment with other kind of more tangible investments. So you'll see a bit more FDI. You'll see IPO type investment. You'll see other types of corporate finance activity. It's all on the basis that you believe emerging market economic activity can continue on as sound as it's been, and that those countries will be managed reasonably well. And I think for the most part that's fair. I would agree with that. I think that if I look at Brazil, it's on a much stable basis than decades ago. If you look at how China ultimately is managed, if you look at how India has been managed, if you look at how South Africa has been managed, if you look at Mexico, all of these countries are on a sound footing. Does that mean there isn't a bubble? That you can't say, because the markets have become very stretched. There's a lot of money has gone into these markets.
Let's bring in another opinion here. On Open Exchange today, Stephen Gunyon spoke to Brett Bishop from Value Grow about emerging markets and whether we're going to see continued growth in this space.
I certainly think if one looks at GDP growth, for example, I think the big exception, if you look at the BRIC countries, certainly for the calendar year that's just passed, 2009, you had Russia with -7% GDP growth. But really, other than that, the BRIC countries, compared to the developed countries like the US, etc., showing much better growth. And obviously we've got China going along at over 8% GDP growth. You've got India at approximately 5.5% GDP growth for calendar 2009, according to the Economist table forecasts. And then, yeah, from a South African point of view, obviously we were down some 2%, or that's again what the Economist forecast will have for the full year, versus the States down 2.5. So I think the BRIC countries, and maybe you can add the S for South Africa on the end of that, the BRICS hopefully will continue to outperform, and certainly that's my view over the coming year at least, that they will outperform the developed markets, which, as Warwick touched on, have become awash with credit and all the money that's been pumped in the States and the UK, for example. The GDP growth there is not expected to be much better than 2% at best going forward, after -2.5% plus for those two countries. And certainly for the last decade, those stock markets in the US and the UK have been dismal returns. I mean, minus 25% on the S&P, about minus 22% on the FTSE over the last 10 years. I wouldn't be rushing there yet.
So Brett clearly saying then that emerging markets should be preferred to the developed environment, given the fact that there's this excess liquidity in specifically the global environment.
That's right. That excess liquidity, a lot of it has found its way into emerging markets. And I need to stress, on the back of good fundamentals. It's not as if this has just been, I can't get any return in the UK because interest rates are zero, so I'm going to go into China. When you look at the fundamentals in these markets, they are sound, and it does warrant a level of investment. Where you need to be concerned about is that those markets are now pretty much, in my sense, priced to perfection. They've run really hard across the board, including our market. They're priced that the growth that you've seen in the last year, 2 years, that continues on and more. And there must be some risks around that. And I would stress that the major risk in the world right now is, as the growth continues to come through, the policymakers have to withdraw the stimulus. They're going to want to withdraw the excess liquidity. They're going to want to slowly ratchet up interest rates. And as they do that, does the world economy stall a bit? And when that excess liquidity is not there, does that drain money away from emerging markets, causing some unraveling of emerging market performance? That has to be a major risk. So you think about it this way. Sorry, Bron.
No, it's fine. I mean, I'm following you and
Yeah.
I'm listening intently here.
Yeah, but if you think about it this way, the problem that the world had, the credit crisis, is a two-part problem. We've only dealt with the first part. The first part was getting the banks stabilized, getting the financial system stabilized, and getting the stimulus in place. Part one done, big tick, markets ran hard. The second part is a crucial part, and that is, how do you normalize the world? How do you normalize interest rates? How do you normalize liquidity and still keep the world intact? That's all ahead of us. That has to take place over the next 12 or 18 months, and that's going to be another test for the world economy, for emerging markets. What the markets are doing right now is they're pricing in that we pass the test.
Exactly. We're 16% off our all-time highs on the JSE All Share.
Yeah.
It's as though we didn't face one of the biggest crises ever.
Yes.
This last year.
That's right. It's a massive vote of confidence to the authorities, right? It's saying, Bernanke, not only did you do a good job, but I believe you're going to do a good job as you exit these strategies. It believes that the central banks are going to manage this well. It believes that banks are going to be in reasonable shape. It believes that the world ultimately will recover. It's factoring a lot. Now, that's not to say that that doesn't happen. Bernanke could continue to manage this perfectly, and you could find the companies recover and earnings recover, in which case, yes, the markets are justified.
But the question is, are earnings going to recover? Firstly, if we look at the international side, we're looking at fourth quarter earnings in the US about to hit us.
Yeah.
And the bottom line is, can earnings sustain what we've seen in terms of share prices?
The earnings, in order to sustain the earnings, the expectation, the forecast earnings, it's all a question of employment. As we go around the world, look at South Africa, look at the US, in order to get that earnings to come through, you can't do it on credit. You need job creation, more spending, more company earnings. So the question for the real world, the real economy over the next 12 or 18 months, what happens to employment? Now, I don't believe that companies are about to rush out and start to employ handsomely, which means that probably companies are going to remain fairly cautious, fairly gradual in terms of their approach, modest pickup in employment when it does happen, which leads you to the thought that the expectation on earnings in emerging markets particularly are probably stretched. They're probably priced to perfection. And you're going to struggle as a fund manager, as an investor, to find true value in shares that you pick right now.
Or perhaps even to justify the share prices of those shares that you've picked right now, given the earnings that we can expect.
That's right. So the way you would have to justify it is saying, I'm holding these shares on a longer term basis now. I'm not holding these shares for the next year. I'm really got my portfolio for the next 2 years. Then I think there's a bit more value, or next 5 years there's a bit more value. But
when we talk about returns on the JSE All Share, the long-term return, as you were saying, is around about 14%. So don't expect it to shoot the lights out. We're not going to see another 29% run on the market.
That's right. I think that's the other thing we've got to factor in, that realistically, what type of return can you anticipate? I would argue that we're going to do really well if we get around about a 10 to 12% return out of equities. Now, when you say that, people say, wow, 10 to 12, that's nothing. Well, it's going to beat cash. And even if you beat cash by 2 or 3%, if you compound that type of difference, it makes an enormous difference over a period of time. In other words, getting 29% out of a market is exceptional. It's a very unusual event. It's not the norm. The average in the equity market is 14.5% over 50 years. That's the type of number that you're looking at.